Every 4 years, America picks a president, and investors start to lose sleep, wondering if the selection that voters make is going to ruin their portfolio for the next 4 years. But what if I told you the biggest secret about the elections and your money isn't what happens on election night? In fact, there's a fascinating pattern about election years and market performance that most financial advisors rarely discuss with their clients. One that challenges everything you think you know about politics and your portfolio. In this video, I'm going to show you exactly how markets really behave before and after election years, and what you need to do to survive. Plus, I'll explain why Wall Street analysts secretly watch the Super Bowl for market predictions, and what that has to do with the relationship between the stock market and elections. And no, this isn't about whether Democrats or Republicans are better for your portfolio. The truth is far more interesting and profitable. But before we get into it, my name is Nolan Matthias, and if you want the truth about finances, and if you believe that there's always opportunity in crisis, then this is the place for you. So do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. In order to begin our conversation about presidential election cycles and how it affects the stock market and your investments going forward, it makes sense to start by discussing the presidential election cycle theory. This is the theory that US markets follow a cyclical pattern aligned with presidential terms. Notably, the first 2 years of any new president is pretty lackluster. And then typically in the third year, there tends to be a pretty strong performance, while the fourth year almost always leads to complete uncertainty depending on who's running and what the outlook looks like for the next president. And this theory stems from historical observations. Markets typically show weaker performance in the first 2 years of a presidential term. Now, typically, the market tends to go in whatever direction it was going before the actual election. And it becomes pretty clear that who is voted on as president actually doesn't have an immediate effect on the stock market. Even though CNN and CNBC will tell you that the first 100 days is the most important, and that after the election, any changes in the stock market are very much based on who was elected, the reality is that's just not true. But as the next election draws closer, there tends to be economic efforts to boost the economy. And as a result, we often see in the third year of a presidential term, the economy get a little bit better, and subsequently, the stock market get a little bit better as well. Because for an incumbent, what happens in the third year and leading into the fourth year very much determines whether or not they will be reelected, as many presidents who have had recessions in the third and fourth years of their terms find themselves out of office very, very quickly. But in times where the economy is good, the likelihood of an incumbent being reelected is much higher. And this whole theory is based on observable patterns from the past. So in other words, while it is just a theory and by no means is it a hard and fast rule, over the last 50 to 75 years, this has typically been what has happened leading up to those presidential elections. But there are exceptions and limitations to this rule. The cycle is by no means foolproof. For example, there was very strong performance in Donald Trump's first year in office. This is likely attributable to the fact that Donald Trump was very much business friendly. And when you have a president who makes it clear that his focus is on making the economy better and making the environment better for businesses, it makes sense that the stock market would go up in value, because rules and laws that affect businesses in a positive manner are obviously going to increase the bottom line of those businesses. But that being said, as much as presidents would like to take full credit for when the economy is good, and challengers would like to put full blame on a president when the stock market hasn't performed as well as it should, the reality is that presidential influence has limited influence over what happens in the stock market. In fact, more often than not, it is external and global economic factors that play a bigger role. And you'll start to understand a little bit more about this when we talk about the Super Bowl and how it affects the stock market. But the reality here is that the president's role in the stock market and the economy has some significant reliability issues, primarily because of varying economic contexts. And what I mean by that is the fact that there's so much more to the economy and the stock market than who's carrying the nuclear football, so to speak. So next, we need to talk about historical market patterns during elections. And the market performance in election years historically shows lower returns than non-election years. Now, this past year would obviously be an exception to that. But again, a lot of the rise in the stock market is probably not due to who was in control of the country and who the president was. And there's 75 years of data to support this trend. Yes, there's always going to be one-off situations where the data doesn't follow, but for the most part, during an election year, there tends to be lower returns. And this is primarily due to the fact that there's higher volatility in those election years because of the uncertainty of what could potentially happen in the future, which leads many people to take their money and put it on the sidelines until they have complete certainty over who is going to run the country, even though who's running the country may not actually matter. And this highlights the election's influence on market sentiment. And keep in mind that the stock market over the long term is very much a value of the growth of investments. But over the short term, it is very much a measure of the market bets. And when less people are making those bets, you can expect that there are, in fact, going to be lower returns. And there's very much fear from both sides. Whether you're Democrat or Republican, there's always fear about who will be the next president and what that will do to the economy and your investments. But here's the truth. Stabilization occurs post-election as uncertainties reduce. So in other words, as soon as it is ironclad who the next president will be, the market sentiment tends to stabilize. And as a result, stock market performance tends to flatten out. And as a result, things very much go back to normal. And what is interesting here is it doesn't matter who is elected, whether it's Democrat or Republican. What matters is that the market starts to understand what it is up against for the next 4 years and can make their investment decisions accordingly. Now, when it comes to the impact of the election results on the markets, well, believe it or not, markets perform well under both Democratic and Republican leadership. Just because there's a change in the president doesn't mean that the US and the US economy is going to stop doing US and US economy things. And it doesn't mean that the economy is all of a sudden going to shift and collapse purely because of a change in political control. In fact, the political party often does not directly affect the long-term market trends. Now, there are some exceptions to that, which I've discussed in another video, which I'll link to at the end. And that more has to do with the makeup of the total government than just who is president. But for the most part, who is president really doesn't have a significant effect on long-term market trends. What matters is that the market adapts to whoever is in power. If one party's elected and there's going to be certain rules that affects the market will adjust in order to make sure that those rules have less of an impact on the investments. It's really that simple. So now let's talk about what's more important than the actual presidential elections. The first is the broader economic conditions, things like inflation, corporate earnings. These are all more influential than elections themselves. Then there's the economic fundamentals that outweigh the political factors in the market performance. Things like debt to GDP, things like the actual GDP numbers, things like inflation, things like interest rates. And as a general rule, aside from 2 or 3 months leading up to an election every 4 years, the focus for the markets is typically on real economic indicators rather than election outcomes. The reality is that the election outcomes have very little effect on the long-term market direction. Now, that's not to say that it isn't always true that the election has a major effect on the economy and the markets. In some cases, there's been major economic recoveries under Democratic administrations, but more than likely, those economic recoveries would have happened anyways. The problem was that the economic crashes happened under Republican watch, which made it less likely for them to get reelected. But it doesn't mean that the Republicans wouldn't have been able to have the same sort of recovery after the fact. In most cases, it was more than likely just bad luck that the economic crashes happened while a Republican president was in office. And in addition to that, we've often seen resilience in markets under Republican fiscal policies. Obviously, the more business-friendly the policies, the better the markets will do. And in all likelihood, the better the economy will get. But regardless, the economic health of the US is really not tied to a political party. In fact, the foundation of the success of the US economy is very much to do with the capitalist ideals that have been in place since day one. And I can't emphasize this enough. Economic performance is driven by structural factors, not party lines. It is driven by the way that the US was built. And the evidence for this is the fact that the US stock market continues to climb regardless of which party is in power. And economic stability, at the end of the day, is a nonpartisan characteristic. As much as presidential candidates would like to have you believe that it makes a big difference who the next president is with respect to the economy and the stock market, the truth is, who gets elected is probably just a rounding error when it comes to your investment. So let's round this out by talking about elections and market dynamics. Electoral cycles introduce short-term volatility in the markets. Yes, that is true. Leading up to an election, you will see the stock market start to flatten out. You will see people less likely to make big bets because they have some uncertainty about who the next president will be. But at the end of the day, the long-term performance remains relatively unaffected by the specific office holder. Markets adapt quickly, adjusting to new administrations, which means for the most part that regardless of who is elected, your investments are probably going to do just fine and will probably do a little bit better after the election cycle is complete. Now, what gets interesting is that political gridlock actually adds to market stability. So it's less about who is elected president and more about the total makeup of the government. Markets tend to favor political gridlock, where there's going to be less policy changes leading to less uncertainty, which leads to more certainty about the fact that markets will increase. And real stability arises when opposing parties control different government branches. For example, when the president is Republican, maybe the House is controlled by the Democrats and Congress is controlled by Republicans. In fact, there's some really interesting data around this, which, like I said, I'll link to a video at the end of this one that talks about exactly that. But political gridlock reduces the likelihood of sudden policy shifts. And the benefit to this is market predictability, which, by the way, is the one thing which is significantly more important than who the president is. And it might be argued that the predictability of the next president is actually more important than who the next president will be. And while I'm not going to make an argument over who is more predictable, I think an argument can be made for both sides. And with respect to the next election, it's very clear that regardless of who gets elected, there is going to be initial market fluctuations due to political outcomes, or in other words, who gets elected. But the historical evidence tells us that this volatility will be short-lived. And the best strategy that an investor like you or I can have is just to maintain a steady approach. Don't let who is elected dictate the moves that you make in the stock market, whether that's going in on some sort of investment because you think that the political landscape will favor it, or pulling out all your money because you're scared of what the next president is going to do. And here's the reality of what you should do. And you've probably noticed a theme throughout most of my videos. First is understand that elections add temporary excitement and uncertainty to the market. This can go both in your favor or it can work against you. But you should have an emphasis on solid economic fundamentals as the main market driver in your investment strategy. Forget the noise, forget all the sensationalism, and just think about your investments as a long-term strategy that if you stick to over a long period of time, and I'm talking 20, 30, 40 years, will inevitably work out in your favor. It is the market timing that makes people go broke really, really quickly. It's the market timing that makes people lose money. But if you are consistent, regardless of what's happening politically or in the economy, and you have a strategy like an all-weather portfolio, for example, where you have different types of assets and you're diversified for risk, well, then regardless of what happens in the economy or in elections, you should be better off. And that's where you need to really detach yourself from the short-term economic stories, the news, all of those things. You need to create a long-term investment plan, and you need to stay focused on it. Avoid being swayed by election year volatility, avoid being swayed by the news, and with patience and economic insight, your portfolio can withstand political, economic, and, well, pretty much any other sorts of shifts that will affect it temporarily. Oh, and that Super Bowl indicator that I was talking about, this is a fun market myth. Since 1967, Wall Street traders have been watching the Super Bowl. And with 80% accuracy, when the NFC teams win, the old NFL teams win, the market tends to rise that year. And when the AFC wins, well, stocks often decline. But the question is this a coincidence or a pattern? Well, there's no real basis for whether or not who wins the Super Bowl is actually going to affect the stock market. And just like the winner of the Super Bowl has little to no effect on the stock market, well, who wins the next election is probably going to also have little to no effect on the stock market. Oh, and by the way, if you want to see that video where I talk about what's more important and how the total makeup of the government is actually significantly more important, make sure you check out this video right here.